G'day guys, Nathan here from Hunter Galloway. Today, we're going to take a deep dive in the Reserve Bank of Australia's tough balancing act amid interest rates rising and explore why you might consider a fixed rate home loan as a potential safeguard. The Reserve Bank of Australia finds itself in a challenging predicament. After consecutive rate hikes, it may be prudent for the Reserve Bank of Australia to consider a breather from the tightening cycle. Being cautious not to over-tighten this cycle is paramount for the Reserve Bank of Australia, just as it's essential for the public to see its efforts in getting us in the right direction. The last increase in interest rates, which took place in June, was labelled a close call. As rates continue to rise into a restrictive zone, further rate rises will need to be justified. The real challenge for the RBA, however, is that they run the risk of lagging behind on their policy changes if the economy persists with uncomfortably high levels of inflation. Historical data from the 1970s underlines the need to bring inflation back into target, but we also need to remember that there will be a stringent requirement on the policy for an extended period of time to avoid a resurgence in inflation. The real threat lies in allowing inflation to return after a brief pause, which could lead people to believing that the pattern is a new norm. The RBA finds itself in a difficult situation where they're inclined to pause rates, but past experiences suggest there may be a rate increase. Continual 25 basis point rate hikes until the economy and inflation trajectories are satisfied by the Reserve Bank of Australia might be the simplest approach. However, this is somewhat in contrast with the aim of avoiding over-tightening. Given the fact that monetary policy operates with significant lag times and continual tightening until the goal is achieved will invariably lead to over-tightening. And if you do find value in this video, please consider hitting that subscribe button, as it does really help out the channel, and a big thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy. The recent robustness in employment, job vacancies, business conditions, and confidence suggest the Reserve Bank can't take it easy just yet. The defining characteristics of a current cycle is the unprecedented demand of labour. The heightening demand for labour, exacerbated by a surge in overseas migration in the first half of 2023, continues to add more fuel to the labour market fire. This influx of overseas workers finding immediate employment adds to the economy demand and therefore complicating the Reserve Bank of Australia's attempt to slow down the economy and bring inflation back to target. And this is where a temporary pause in the tightening cycle could be beneficial. However, if the labour market doesn't subside with interest rates where they are at the moment, the debate won't be about how high the cash rate will get in the fours, say 4.6 to 4.8%. The discourse might actually shift whether the cash rate might need to head towards 5.5% or even higher. Understanding the balancing act the Reserve Bank of Australia is trying to achieve is key. They're looking to slow down the economy just enough to cool inflation, but they're also somewhat stunted by the growth they're seeing in the labour market, being supercharged by overseas migration, which makes the task even more daunting. This upward trend in the cash rate we're seeing puts additional pressure on homeowners with variable loans, and this is where considering a fixed rate loan can come into play. In this environment of raising interest rates, locking into a fixed rate home loan can give you certainty and provide you with some security. With a fixed rate loan, borrowers will have the benefit of knowing exactly how much they need to pay over a set period of time. At its core, a fixed rate mortgage can provide you a sense of security, since essentially your rate is frozen and remains unaffected by any rate increases by the Reserve Bank. However, it's not all sunshine and lollipops for fixed rate mortgages, as they often lack flexibility and extra features that variable home loans can sometimes provide. It's important to be aware that fixing in your home loan isn't a one-size-fits-all approach. While it can provide you some stability and predictability, there can be some trade-offs, including if there are any rate cuts, it's not going to be passed on whilst you're in your fixed rate period. You can be limited in features available, and if you do break your fixed rate during the fixed period, there can be some hefty penalties that apply. Now, let's talk about the pros and cons of a fixed rate. Let's start off on the first one. And the first pro of fixing in your loan is that you won't be affected by any rate increases until the fixed term ends and you revert back on the variable. So it gives you that stability you might be looking for, especially in an environment where rates are going up. The second is your monthly repayments are going to be stable, thus you know exactly what you're up for and you have an ability to budget right around those repayments for a set period of time. And the last is you're not going to have any unexpected additional costs because the Reserve Bank moves the rate. So you have predictability in your monthly repayments As such, you can plan accordingly. Let's talk about some drawbacks and the cons of fixing in your loan. If there are any potential cuts in the cash rate, you won't benefit. So if rates do start to drop before your loan term ends, you'll be stuck with a higher rate. Certain facilities such as extra payments, redraw and offset accounts might not be accessible with your fixed rate. If you sell your property, refinance or switch back to a variable rate, there can be high break fees associated with getting out of that fixed rate. Upon completion of your fixed rate, you'll transition to a potentially higher variable rate unless you refinance or make changes before. Now, when should you not look to fix in your loan? Well, the first is when rates are on the decline. The second is where interest rates are expected to peak soon. And the last is if you want flexibility, such as having an offset account or making extra lump sum repayments into the loan. This is where splitting your loan with a part fixed and part variable might see you get the best of both worlds here as well. Before locking in your fixed rate, borrowers should consider the trajectory of fixed rates. Fixed rates are projected based on the market's expectations. If a fall in rates is anticipated, fixed rates may be lower than variable rates. On the contrary, if rates are predicted to go higher, fixed rates might be higher than the variable rates. In terms of the term to fix in, the fixed rate is often chosen based on expectations of the future rate rises. A short-term fixed rate like a 1 or 2 year fixed rate might give you that stability you might be looking for, especially if things are a little bit volatile. While a longer-term fixed rate like a 5-year term might give you a better long-term yield, and you're only going to know that in hindsight. It's always difficult to know. And remember to like, share and subscribe to stay informed with all things property and finance. And this is where you might consider splitting your loan, where part of your loan remains variable and the rest remain fixed. This allows you to get the best of both worlds, where you can make those extra payments on the variable, have an offset on the variable, and get some stability, especially in an environment where it's difficult to know where the rates are going to go. If you go half fixed, half variable, it's the ultimate hedge, because whatever happens, whether rates go up or down, you're going to find that half of your loan benefits either way. It's really difficult to know what's going to happen. Even the experts themselves routinely get it wrong. So ultimately, you've got to do the best based on your own individual circumstances, your own individual budget, and what your upcoming costs and expectations are for the future. And this is where working with a mortgage broker like ourselves can help. Here at Hunter Galloway, we work with a lot of home buyers, and especially those that have been finding it challenging recently with all these rate hikes and want to discuss options around whether they fix, go variable, or renegotiate. Give us a call on 1300 088 065, and as a mortgage broker, we deal with people Australia-wide. There's no cost for our service. You can jump on our website to get in touch as well, huntergalloway.com.au. We'd love to talk, so get in touch. Guys, as always, thanks for watching, and we'll see you next time.